Catastrophe insurance issues. The term catastrophe in the property insurance industry denotes a natural or man-made disaster that is unusually severe. An event is designated a catastrophe by the industry when claims are expected to reach a certain dollar threshold, currently set at $25 million, and more than a certain number of policyholders and insurance companies are affected. The magnitude of the damage caused by Katrina and the potential damage hurricane might have caused had it not weakened from an intense category 5 hurricane has triggered our examination not just among insurance and reinsurance but also among public policy and political leaders of how the and reinsurers but also among public policy and political leaders of how the United States deals with the financial consequence of such massive property damage and personal loss. Disaster losses along the coast are likely to escalate in the coming years, in part because of huge increases in development. One catastrophe modeling company predicted that catastrophe losses will double every decade or so due to growing residential and commercial density and more expensive buildings. Data from the Kansas Census Bureau collected by USA Today show that in 2006 34.9 million people were seriously threatened by Atlantic hurricanes, compared with 10.2 million in 1950. Before the 2005 hurricane season, Hurricane Andrew ranked as the single most costly U.S. natural disaster. Man-made catastrophes such as the attacks on the World Trade Center can also cause huge losses. The attacks led Congress to pass the Terrorism Risk Insurance Act (TRIA) in November 2002. Since then, TRIA has been reauthorized twice. The latest reauthorization passed at the end of 2007 extended the law to 2014. TRIA provides a federal backstop for commercial insurance losses from terrorist acts, making it easier for insurance to calculate their maximum losses for such a catastrophe and thus to underwriter the coverage. See the topic on terrorism risk and insurance. The typical homeowner's insurance policy coverage covers damage from a fire, windstorm, hail, riots, and explosion, as well as other types of loss such as theft and the cost of living elsewhere while the structure is being repaired or rebuilt after being damaged. Commercial property insurance policies generally cover the same causes of loss with some variation depending on the coverage selected. Flood and earthquake damage are excluded under homeowners policies. Separate policies are available but are covered under the comprehensive portion of the standard out policy, which more than 75% of drivers who buy out auto liability insurance purchase. The insurance industry tracks catastrophe to monitor claim cost, assigning a number to each catastrophe. Each claim arising from the event is tagged so that total industry-wide losses can be tabulated. The term catastrophe is often used in the property insurance industry in a narrow way to mean a catastrophic event that exceeds a dollar threshold in claims payouts. This figure has changed over the years with inflation and the increase in development of areas subject to natural disasters. Starting in 1997, the catastrophe definition was raised from $5 million to $25 million in insured damage. There have been 4 catastrophes that fell into the mega catastrophe category, greatly exceeding the $25 million threshold. The first two, Hurricane Andrew 1992 and the Northridge earthquake 1994, were both watershed events in that they were far more destructive than most experts had predicted. A disaster of this type would be the third, the terrorist attack on the World Trade Center. Of this type would be the terrorist attack on the World Trade Center in 2001. Alternative insurance attitudes about man-made risks worldwide. Hurricane Katrina 2005. The fourth catastrophe is not only the most expensive natural disaster on record but also an event that intensified discussion nationwide about the way disasters, natural and man-made, are managed. It also focused attention on the federal flood insurance program. See the topic on flood insurance. Telephones and driving. Increasing reliance on telephones has led to a rise in the number of people who use the devices while driving. There are two dangers associated with driving and cell phones use, including text messaging. First, drivers must take their eyes off the road while dialing. Second, people can become so absorbed in their conversation that their ability to concentrate on the act of driving is severely impaired, jeopardizing the safety of vehicle occupants and pedestrians. Since the first law was passed in New York in 2001, banning handheld cell phone use while driving, there has been debates as to the exact nature and degree of hazard. The latest research shows that while using a cell phone when driving may not be the most dangerous distraction because it is so prevalent. It is by far the most common distraction in crashes and near crashes. Research studies about cell phone use while driving have focused on several different aspects of the problem. Some have looked at its prevalence as the leading cause of driver distraction, and others have looked at the different risks associated with handheld and hands-free devices. Still, others have focused on the seriousness of injuries in crashes involving cell phone users and the demographic of drivers who use cell phones of increasing concern is the practice of texting. In Journey 2010, the National Safety Council (NSC) released a report that estimates that at least 1.6 million crashes, 28% of all crashes, are caused each year by drivers talking on cell phones. 1.4 million crashes, and taxing 2 lakh crashes. The estimate is based on the data of driver cell phone use from the National Highway Traffic Safety Administration and from peer-reviewed research that quantifies the risk using cell phone and texting while driving.